October 19th, 1987. In 6 short hours, Wall Street loses nearly a quarter of its value. Panic spreads across global exchanges before humans even realize what triggered the collapse. In the mid-1980s, Wall Street operated under a spell of supreme confidence. Between August 1982 and August 1987, the Dow Jones Industrial Average more than tripled, fueling a relentless bull run that seemed to defy gravity. As capital flooded the financial system, large pension funds and insurance companies shifted massive assets into passive index funds, drastically increasing the market's collective exposure to sudden shifts. For these institutional portfolio managers, the objective was clear: ride this historic wave of prosperity, but secure a reliable safety net to protect their massive gains. During these years, an institutional shift transformed how Wall Street calculated risk. Academic theorists and quantitative analysts flooded trading floors, bringing complex mathematical models that promised to turn volatile speculation into a predictable science. Institutional managers, increasingly detached from traditional stock picking, placed their trust in these computerized formulas. They sought a mechanical way to guarantee downside protection without sacrificing the explosive upside of the market. It was the perfect breeding ground for a new kind of financial engineering. This climate of optimism birthed a risk management tool designed to eliminate human fear, constructing a fragile illusion of safety. The market was growing larger, faster, and far more interconnected. But beneath the glossy surface of the 80s boom, the foundations of the global financial system were quietly growing brittle. In 1980, academics Hayne Leland and Mark Rubinstein, alongside marketer John O'Brien, founded Leland O'Brien Rubinstein Associates. Their goal was to turn a complex mathematical theory into a marketable product. They discovered that by constantly rebalancing a mix of stocks and cash, they could recreate a protective put option. They packaged this dynamic hedging strategy under a seductive name: portfolio insurance. The program promised institutional investors a financial miracle: unlimited upside with a guaranteed floor on losses. For massive pension funds and insurance companies, it was an irresistible safety net. Major institutions like Wells Fargo Investment Advisors and Aetna Life Insurance eagerly signed up. By 1986, the firm's algorithmic formula guarded over $45 billion in assets. The design was elegant, but it relied on a dangerous assumption. The mathematics required continuous, unlimited market liquidity to execute the necessary trades. On paper, under normal conditions, the safety net was flawless. No one considered what would happen if everyone tried to squeeze through the exit at the same time. The mathematical heart of portfolio insurance was a calculation known as delta. This formula measured the sensitivity of a protective put option relative to the shifting stock market. As equity prices dropped, the portfolio's delta shifted, demanding immediate action to maintain the promised safety floor. The mathematical instruction was clear, simple, and entirely unyielding. To protect the fund, the manager had to sell assets. The further prices fell, the more assets the model forced them to liquidate. To execute these massive trades quickly and cheaply, Wall Street turned to the Chicago Mercantile Exchange. Instead of selling thousands of individual stocks on the New York Stock Exchange, program traders used S&P 500 index futures. This financial innovation allowed institutions to hedge multi-million-dollar portfolios with a single click, driving transaction costs down and execution speeds up. But this efficiency removed the final barrier to panic: human hesitation. Imagine a risk manager sitting in a dimly lit office in mid-October 1987. As the market ticks downward, their computer terminal flashes a series of automated alerts. The model does not care about market sentiment, company fundamentals, or economic health. It sees only numbers. There is no debate, no nervous phone call to the trading floor, and no room for intuition. The computer executes a pre-programmed mathematical command. In the futures pits, sell orders land with cold, mechanical precision. The system was built to eliminate risk, yet its very design meant that as the market fell, the algorithms had no choice but to keep selling, faster and faster into the abyss. The true danger lay in the uniformity of the design. By October 1987, tens of billions of dollars were governed by nearly identical software. When the market dipped, these independent systems did not act independently. They computed the exact same math, reaching the exact same conclusion at the exact same moment. They all had to sell. This created a devastating bottleneck. The models assumed continuous, infinite liquidity, the belief that there would always be a buyer on the other side of the trade. But as a massive synchronized wave of automated sell orders hit the futures market, the pool of available buyers evaporated, making each new sale more damaging than the last. This was a systemic lockup where different mechanical layers ground against each other. When portfolio insurance algorithms dumped index futures in Chicago, they created a price gap between the futures market and actual stocks on the New York Stock Exchange. That gap triggered index arbitrageurs. These programs rushed to buy the cheap futures and sell the underlying equities on the NYSE, instantly transferring the pressure to New York. As these forces fed on each other, the market's internal plumbing began to fail. Order execution times lagged, the ticker tape fell behind, and price data became unreliable. Wall Street had constructed a digital loop where every drop in price triggered more sales, and every sale pushed the market deeper into a self-reinforcing tailspin. At 8:30 a.m. in Chicago, S&P 500 futures plummeted, signaling a tidal wave of selling heading straight for New York. By 9:30 a.m., the opening bell at the New York Stock Exchange unleashed chaos. Sell orders overwhelmed buy orders 3-1. Within 5 minutes, 95 stocks halted trading. The exchange's routing system buckled under the load, and the consolidated ticker tape fell behind by more than an hour, leaving traders blind. On the floor, the physical infrastructure of Wall Street fractured. Telephone lines jammed, then failed entirely as panicked brokers screamed into dead receivers. NYSE specialists, legally obligated to maintain orderly markets, watched their capital evaporate. By mid-morning, 13 specialist units had completely exhausted their buying power. One broker stood in the screaming crowd, staring at a screen flashing endless sell orders, with absolutely no buyers on the other side. The liquidity that the mathematical models took for granted had vanished. A systemic lockup was unfolding. The panic quickly breached borders, cascading into London and Tokyo as the global financial grid began to go dark. By Monday night, the crisis leaped from trading floors to the very core of the global financial system. With London and Tokyo buckling, plunging stock prices threatened to freeze the global banking network. Clearinghouses faced billions in unmet margin calls, threatening to drag down major commercial lenders. Behind closed doors, central bankers and regulators scrambled to prevent a total credit seizure. The Federal Reserve prepared to flood the banking system with emergency liquidity, hoping to prevent a complete collapse. The immediate task was no longer protecting private wealth, but keeping the global payment system alive before the opening bell. The credibility of the entire financial architecture hung in the balance. The federal government launched an immediate investigation, culminating in the Presidential Task Force on Market Mechanisms, known as the Brady Commission. Investigators faced a harsh reality. The physical NYSE and the electronic Chicago futures markets had decoupled, exposing a fatal plumbing defect. In response, regulators rewrote the rules of engagement. They implemented system-wide circuit breakers, mandated pauses designed to halt trading when declines reached predetermined thresholds. These structural firewalls did not ban algorithms. They forced them to pause, giving human operators time to catch up with the machines. The redesign of market architecture had begun. Today, our markets move in microseconds, entirely ruled by cold code. We traded human panic for automated execution, chasing the illusion of perfect control. But when the next flashpoint strikes, the machines won't ask for permission. Are we truly in control? Share your thoughts below.